Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are on episode 2 of my portfolio update. So if you're joining us for the first time, I have made a bet with myself to show my subscribers that you can grow a $100,000 portfolio in 2 years or less. Currently on screen you can see our progress with this, and in the last video you can see that the balance was around $50,030.25, and then just a mere 2 weeks later, we have gained close to $4,000. Now, this is very impressive. Why? Because right now, the overall macroeconomic environment is very negative, and the stock market is actually crashing right now. But due to my proper risk management, this has not only shielded me from further downside in my portfolio, but it has also made me money while the stock price is falling, and we'll talk more about that next time when I do my next stock portfolio update. Previously, we talked about my major investments, which would be my core ETFs, which make up around 80% of my portfolio as of right now. However, these are really good ETFs to just buy and hold forever, and I don't plan on selling these. MTUM, SCHD, QQQ, and one of these four. I honestly, depending on my mood, switch between VTI, VOO, IWI, and RSP. Now, the downside to this portfolio and the risk that I am taking on is actually I'm overexposing myself to two particular companies, and that would be Apple and Microsoft. The reason why this is pretty bad to do, considering that I'm buying ETFs, is that there's cross-pollination happening here, where multiple ETFs that I'm investing in have their main holdings as either Apple, Microsoft, or both of these companies. The reason this hurts me is because of their expense ratios. In this video, we are going to talk about the dividend yields of these ETFs, the expense ratios, my top 10 holdings, and how this has impacted my overall stock portfolio very positively. So let's just dive right into it. Remember to go and smash that like button or comment your thoughts down below for more portfolio updates from me. And without further ado, let's get right into it. So MTUM provides me a dividend yield of 2.20, which is honestly not that bad. However, the expense ratio is rather high, coming in at 0.15, and I am not very excited about that, but I do like how MTUM actually rebalances itself every 6 months automatically. I don't have to do anything or actively manage that ETF. The next ETF I have is SCHD, and if you're wondering, these all have around a 20% allocation as of the time of that previous recording. This is a dividend ETF that gives me a dividend yield of 3.51, and it has a lower expense ratio of just 0.06. QQQ, which is very technology heavy, has a dividend yield of 0.81, which is honestly not that bad, but it does have a very high expense ratio of 0.2. There are a few ETFs that have and track the NASDAQ 100 with a lower expense ratio, but I will talk about that in another portfolio update video. And then lastly, I just use VTI for the last one, of a 1.68 dividend yield and a 0.03 expense. If these averaged out, I would have a dividend yield of 2.05, which I am drip investing back into my portfolio. I'm not spending this money, and I'm using these dividends to reinvest back into these same ETFs, so my next dividends are greater, and the expense ratio is around 0.11. Honestly, you would want your expense ratio probably below 0.1, but even that is rather high considering that there are other investments that you can get that have lower expense ratios. Now, the problem is that I'm paying this expense ratio just to invest a lot of my money into only two stocks, and that would be Apple and Microsoft. So that is a downside of this portfolio. However, to offset some of this risk, I do have a couple singular investments that I tend to invest into on a regular basis. That would be companies like Alphabet, Amazon, United Health, Berkshire Hathaway, and the list goes on. If you want to know the top 10 companies that I am investing in right now, according to my portfolio weight, here are the ticker symbols for you to look into. Now, I wanted just to go over the top 10, but there are actually 11 here because I wanted to have an honorable mention of Union Pacific, and of course, I have highlighted their current dividend yields that they are giving investors. So I would say we are currently on track to meeting $100,000 in 2 years or less, considering that while the stock market is falling, we are still making a good amount of money. We have gained probably around $3,000 in the last 2 weeks, which is not bad. But let's dive deeper into why I have picked these 10 companies and why my portfolio is anticipated to reach $100,000 in 2 years or less. The next slide we have on screen goes over the current stock prices of my top 10 companies in my portfolio if we exclude Apple and Microsoft. So we have Amazon coming in at $112, Alphabet coming in at $93, Berkshire Hathaway Class B shares coming in at $291, and the list goes on. You can see United Health, Johnson & Johnson, Visa, Meta Platforms, which is trading at a crazy discount. Right now, because this has dropped below $100, this is trading at over a 6-year low right now. Literally, we could go back to 2016, and that's how low the company's stock price has dropped. So you're saving yourself 6 years worth of investing if you decide to invest into Meta Platforms right now while the stock price is falling. Now, that's not necessarily the safest thing to do because right now it could be a falling knife, but eventually I believe that Meta Platforms will rebound because the company is an absolute cash cow. Another company that I really like is McDonald's, of course, and lastly, we have Honeywell International and Union Pacific to round out my top 10 holdings. Now, there is a plethora of other companies that I own on the S&P 500 or that make up the S&P 500, but these companies specifically, I want more exposure to these companies that I am not getting through ETFs. I also have a couple singular risky growth companies that really boost my portfolio during times of bull markets, rallies, and flat out stock market surges, but that will be in a later video where I talk about my more risky investments. Right now, I am going from my safest investments, such as my ETFs, then to my large cap singular growth stocks, and then onward. I also want to bring to your attention that if we backtest this portfolio, or rather 3 portfolios, we can understand the growth of my portfolio and how my strategy works. So in portfolio 1, we are going to have just the ETFs, right? We're just going to have MTUM, SEHD, QQQ, and VTI, all at a 25% portfolio weight. Then we're going to adjust 11 companies that I showed you before that will also add up to a 100% allocation, but in this example, they are all going to be equally weighted, even though in my portfolio they are not equally weighted, and we're going to compare this to the stock market benchmark, which is going to be the S&P 500, which is VOO. If this strategy does not beat the S&P 500, this is not a good strategy that you would want to adopt. However, I thoroughly believe that this will, but we have a couple of assumptions. When we backtest this portfolio, we're going to go back to 2000 until the present day. Our initial investment will be $10,000, no more or no less. We're not going to add any money to this portfolio. There will be no rebalancing, and for me personally, I do not really like rebalancing. Rebalancing, honestly, I think does more harm than good because it really allows your emotions to take over as you continuously mess with your portfolio. You would probably be better just investing everything into VTI and VOO and just letting it ride instead of constantly trying to rebalance your portfolio, because over the long term, that strategy of buy and hold has outperformed the majority of investors and professionals. But again, that's a whole nother video that I will get in. We are also going to reinvest any dividends that we get from these ETFs or singular stocks, and we are going to invest them back into the same companies that gave it to us in the first place. So now that you know these different portfolio strategies, to where we have the ETFs, which make up the bulk of my core holdings in my portfolio, we're going to compare it to a hyper extreme risky growth portfolio of just large cap companies. And then of course, we're going to compare that to the S&P 500 benchmark. Hopefully these portfolios can outperform that over the last 22 years. So with that being said, I say let's analyze this and see our results. So if we look down here, you can see first a pie chart of these various investing strategies. And this is what it would look like. Now again, you don't have to have these equally weighted. There's also an ETF that I quite like that has an equally weighted S&P 500, which I am a huge fan of. So actually, let's look at the results down below. So for our ETFs, that is going to be in blue. So our ETFs took our $10,000 initial investment and it has turned it into $25,676 with a CAGR, or compounding annual growth rate, of 11.38%. That outperforms the S&P 500 by almost 2%. Also, I want to say that these are not inflation adjusted, but if you want to see adjusted for inflation, you can see the compounding annual growth rate, or CAGR, is going to be around 6.91% for the S&P 500, 8.3% for our ETFs, and the singular growth companies is going to be 11.93%. Clearly, from the graph down below, you can see that the singular growth companies outperformed the other ones over the last 22 years. But the ETFs did outperform the S&P 500 because the S&P 500 only gained and created value from $10,000 to $22,000, so you only gained $12,000 of profit over 22 years. But this then begs the question, why wouldn't I want to test the single extreme risk growth strategy in my personal portfolio? Well, this is mainly due to its extreme risk. It's very easy in investing to where investors have what's called hindsight biased, to where they would swear that this is the best strategy going forward, but they're using prior data, and past data does not dictate future data, even though it is a good guidance to use. For instance, if any of these singular growth companies went completely out of business, we would lose around 10% of the entire portfolio, which would be catastrophic for your overall gains. That is too much risk. You're taking on unnecessary risk of losing 10% of your overall portfolio. For ETFs, I don't have to worry about that. My ETFs consistently and together own over 500 companies, to where even if 100 of these companies went completely out of business, which is extremely unlikely, my portfolio virtually would not be touched. So that's why I would rather advocate and invest into my core ETFs to where I do beat the S&P 500 by a substantial margin, but I don't take on the risk of a extremely risky portfolio of just 10 to 11 stocks that are all large cap, because who knows what would come of these companies in the future. For instance, Meta Platforms is falling right now at a huge clip. And if we had, let's say, 20% of our portfolio allocated to just Meta Platforms, our portfolio literally could never recover from those losses. That's why I really like the ETF strategy of investing, to where you only need to identify a few ETFs that have given you strong returns over the last couple of years and will most likely continue to give those returns in the future. And if not, it doesn't matter because you are exposed to instant diversification. This is why, while singular growth stocks or large cap stocks are falling, there are ETFs that are actually making money due to their either high dividend yields or because of other ETFs that I will talk about in the next video. So with that being said, you really just need to practice proper risk management once you start to enter into your portfolio so you can start making money even while the overall stock market is falling. And to give you an example of this, this is what we're dealing with right now, this giant decline of around 20%. Yet while the overall stock market benchmark is falling, my portfolio is still giving me thousands and thousands of dollars because I am practicing a proper risk management. I'm not overexposing myself too much to singular risky growth companies while these ETFs are giving me fantastic dividend payouts in the meantime. The final thing I will add to this video is that these portfolio comparisons are not very accurate because my personal portfolio would actually be between the ETF portfolio and the singular portfolio because I have combined these two types of portfolio strategies. So my overall portfolio would probably follow a trend literally almost exactly between these two, and that's where mine would probably end right here. So I would have made well over a net profit of over $15,000 but less than around $24,000. So I would probably be hovering in the $20,000 range, which not only is the better strategy in terms of risk management and allocation, but it also is better for long-term stock price appreciation, which in the long term will even outpace the singular growth company. But again, we will talk more about that in another video. So that's what I would want to add. Comment your thoughts down below. Subscribe if you are new. Smash that like button for more news updates just like this one on my personal portfolio, and I will see you in the next YT video.